I firmly believe that ultimately gold and Bitcoin are going to go to much higher levels than they are today as a result of what I consider to be kind of 5 and 10 year trends towards monetary debasement. But, there's no in a bull market, there's no free ride. And so in my view, gold is shaking off the latecomers. I mean, if you price chase gold into 5,400, you're not feeling great right now. Most of the gold I bought much lower than today, and I wasn't a buyer at 54. And in fact, I've said this in my tweets in the last 4 months that I've been kind of selling gold and gold related items and buying Bitcoin and Bitcoin related items, because if you look at the chart of those two compared to one another, Bitcoin is relatively cheaper.
At the heart of Lepard's perspective is the idea that both gold and Bitcoin represent sound money, assets that cannot be easily created or manipulated by governments. Gold, he explains, is analog sound money. It has endured for thousands of years because of its natural scarcity, durability, and independence from political systems. Its supply grows slowly, about 1.7% per year, and cannot be artificially inflated. Bitcoin, on the other hand, is digital sound money. It introduces something revolutionary: digital scarcity. Despite being intangible, Bitcoin's supply is mathematically capped at 21 million coins, enforced by a decentralized network of computers across the globe. This makes it immune to the kind of monetary debasement that plagues fiat currencies. While they differ in form, physical versus digital, they share a common purpose: preserving value in a world where traditional currencies are steadily losing purchasing power.
It's very interesting. I mean, they both represent a couple of things. They represent sound money. Gold is analog sound money, and Bitcoin is, in my opinion, digital sound money. Some disagree, but let's start there. But they also tend to represent, liquidity, in the sense that, they're sound money. They're a cash form of sound money. You can very easily convert them into cash, dollar cash. And, one of the things I've heard that's possible, I mean, and gold, by the way, in my opinion, gold really got ahead of itself last year, right? I mean, it was an unbelievable year what happened in gold last year. The increase in the price there, we hadn't seen that since the 70s and the real inflation explosion back then. And so to me, what it was smelling out was the sovereign debt crisis that's on its way to becoming real. And it got ahead of itself. And obviously there was a lot of price chasers and has corrected. It's interesting. Bitcoin went through that and went through it earlier. I think Bitcoin's a little more sensitive to liquidity. In October it was at 126, and that was as low as the mid 60s. I think it spiked, it wicked down to like 60 very briefly. And to me, they're both an indicator of kind of, things are tight, liquidity rise. The piece of the picture that doesn't really fit, and I'd be curious to see what you guys think of it, Jim, too. I mean, Jim in particular, but it is the stock market. I so but think about it. I mean, one of the arguments I've heard, and it kind of does resonate with me. So let's say you're in the Middle East, and let's say you've got a lot of gold holdings, and let's say you're thinking, I just soon get my wealth out of this area, this region. It's not a great region to be in. Well, if the gold holdings are physical, pretty hard to move them. Not easy to ship or transport, but probably reasonably easy to sell them for cash, and then wire the cash out or put the cash into Bitcoin, and very easy to move the Bitcoin. You got a lot of cross currents going on in all of these assets. I firmly believe that ultimately gold and Bitcoin are going to go to much higher levels than they are today as a result of what I consider to be kind of 5 and 10 year trends towards monetary debasement. But, there's no in a bull market, there's no free ride. And so in my view, gold is shaking off the latecomers. I mean, if you price chase gold into 5,400, you're not feeling great right now. Most of the gold I bought much lower than today, and I wasn't a buyer at 54. And in fact, I've said this in my tweets in the last 4 months that I've been kind of selling gold and gold related items and buying Bitcoin and Bitcoin related items, because if you look at the chart of those two compared to one another, Bitcoin is relatively cheaper,
Yeah.
than gold. Since the war started, it's outperformed gold. There's a couple of charts. In fact, I retweeted one on my
But
thread.
that's more of gold getting its ass handed to it, right? Yeah.
Well, part of it's gold, yeah, gold getting hit, and but Bitcoin coming up. But I think you make a very good point. I think the reason why the bonds are hurting is that we had a fiscal crisis going on before the war, and wars are enormously expensive. I mean, the last wars in the Middle East cost us $8 trillion. The run rate on this war, I've read in a couple places, is kind of 600 or 700 trillion of additional. They just
Bill.
Senate just
Yeah.
came and asked for a $200 billion supplemental. 2 trillion I mean, they did a trillion of deficits in the first 5 months. So if you annualize that, we're running at an annual rate of over 2 trillion in deficits. Then add in the war, could that take us to 2.7? I mean, now you're starting to get kind of COVID like, and yeah, who's going to buy the bonds? I mean,
Okay.
and Basenta said things like, "Yeah, we've got no problem paying for the war." And by the way, who better to have do a dovish monetary policy than somebody that everyone thinks is a hawk, right? So
Bingo.
it's like only Nixon could open up China because Nixon was a hard ass. I mean, if McGovern had gone to China, everyone would have thought he was going to give away the store. So you've got this hard ass guy who's probably been read in on what he's got to do. In my opinion, this, like I said, this is just a guess. We'll see. Maybe I'll be right and everyone will say I'm smart, but maybe not. I think they're kind of cooking up some new plan. My guess, and they're going to have it's going to have some new acronym, and they're going to come in and they're going to say, look, it's going to be like what we did in World War One. They're going to say, look, we're not going to do QE because we can't put it on the Fed balance sheet, but we've got this new special program for the banks, and we are going to give the banks more capital at lower cost, below the Fed funds rate, whatever the number is. But the condition is that the banks have to use it to buy treasuries and hold them. And so it's all going to go on the bank balance sheet. So we're going to get the money printing, and we're going to get the big print, but it's not going to be on the Federal Reserve balance sheet. And this is in World War One. What they did was, they had a hard time financing it, and it led to 100% inflation. By the way, everything doubled in price throughout that war. But what they did is they went, the Fed had just been formed, and they were very, smart about it. They went to the banks and they said, look, we're going to sell these Liberty bonds at 3.5%. And we know we can't find enough buyers for them, and we need to do that in order to finance the war. And we're going to give you money out of the Fed backdoor at 3%. So you're going to you're going to get a 50 basis point spread for free. And guess what? The banks bought all Liberty bonds. I mean, other people did too, but the banks were the biggest buyer. So my sense is that's what's going to happen here. And now, guys, they've got the perfect cover for it. We're in an existential war and a threat for, the Middle East and, blah, 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 right? I mean, these evil people are going to take over the Middle East if we don't do it. My sense is that they can't stop the big print. The math is undeniable. I've shown that in many podcasts where the lines are crossing, where they've got to grow the money supply or else the debt pyramid's going to collapse. So, that's kind of my guesstimate as to where we're going.
One of the most important parts of Lepard's thesis revolves around government debt. He argues that the global financial system, especially in the United States, is heading toward a sovereign debt crisis. With deficits running into trillions and additional pressures from war spending, governments face a fundamental problem. Who will buy all this debt? His answer? They will be forced to print money, directly or indirectly. Lepard speculates about potential policy responses, including creative mechanisms to fund government spending without explicitly expanding central bank balance sheets. For example, governments could incentivize banks to buy bonds using cheap financing, effectively creating money through the banking system. This kind of backdoor monetary expansion, he argues, is inevitable. And historically, such policies have led to significant inflation, like during World War I when prices doubled. The implication is clear. Currency debasement is not a risk, it's a certainty.
Look, the crypto world has done an enormous amount of damage to Bitcoin, just an enormous amount of damage. The Sam Bankman-Frieds of the world, Trump coin, Melania coin, World Liberty Financial, all these other coins are all just horseshit. They're grifts. There are other people trying to pump and dump something to dumb investors and run it up, and then they sell into it. And it's sickening to me, and it's not what Bitcoin is. Let's go back to first principles and what Bitcoin is. And let's go back to, and I said earlier, I'm not an oil guy, and I'm not, but I am a gold guy, and I've always been a gold fighter for a long time. I still love gold. I hate it when Bitcoiners shit on gold. I hate it because gold is the
I do
original.
too.
Gold is the original sound money, and I still have a lot of gold, and I've got a fund that invests in gold, gold mining companies, and gold's going to be around for a long time, guys. I mean, it's not going to disappear overnight. Over time, Bitcoin's going to steal share, but that's for a future decades. But gold was originally chosen as the best form of sound money because its supply is limited, and it's not controlled by any particular government. I mean, it's geologically constrained. It comes out of the earth. We know what it is. There's only so much of it. We add 1.7% to it every year, and you can't print it or debase it. So that's why gold has endured, and 6 billion or 7 billion people, whatever the number on the planet is today, it's 8 maybe, all understand that gold is real money and always has been real money. Now, that doesn't mean you transact in it. Nobody goes down to the corner store with a gold coin, but if you want to save for a long period of time, gold has proven its metal. I mean, it literally, it tends to, produce, buy about the equivalent amount of bread or clothes or whatever that it used to in olden days. And fiat currencies come and go, and most fiat currencies have failed. So Bitcoin was the original proof of work sound money. So I mean, gold was the original proof of work sound money. So here comes Bitcoin. What Bitcoin is, Bobby and Jim, and I know you guys know this, but I'll just repeat it for the audience. Bitcoin is digital scarcity. Okay. And that's a tough concept to get your head around because everyone thinks digital. Oh, that's a computer file. That's a video. That's an audio file. God, you get one, you can make 1,000 of them. You just hit repeat and there's no such thing as digital scarcity. And yet, the guys who devised it crafted a system whereby, they've got an immutable form of digital scarcity that's stored in 30,000 computers all around the world, and that every 10 minutes transacts between those computers to show that now I have one less coin and Bobby has one more coin. And so, this is really, in a sense, because it's scarce, because it's capped at 21 million, it's, in my opinion, it's kind of emerging as digital gold. Now, for that to happen, people have to believe that. And if nobody believes that, it would just die on the vine. But over 17 years, with fits and starts and enormous volatility and up and down and tons of FUD and all kinds of problems, the trend has been up and to the right. Now, not consistently, and the last 4 years have been kind of shitty, to be frank. But let's not forget that as recently as last October, it was at 126, and it's at 70-ish right now. And, I'm pretty sure someday it'll be at 200, and then someday it'll be at 300 and 400. And the reason I say that is I see evidence that the usage is continuing, that the number of addresses, actions, use cases, etc., is going up over time. And I also believe that in the younger generation in a digital world, I mean, there are two kinds. I mean, anyone who wants to buy something that's sound money, if you're my age, you probably have bought gold. But if you're 30, you're thinking, Jesus, gold, that's kind of a boomer rock. And, it's just a stupid rock. Who really wants it? Oh, I've got this sexy, cool internet money that I know is defensible and can't be printed. I'm going to buy that instead. And it's easier to store and easier to move. And so those two characteristics have made younger people trend toward it. And, I think it's just a matter of time. I mean, it's interesting. If you study the history of some of these big technical innovations, and I studied a couple of them and I talk about them in the book, the printing press came out in 1400 or something. Gutenberg invented it, but it took 200, 300 years before books were really a thing and widely spread. So that's a lot of time. Electricity, Edison started, offering electricity in New York City in the 1880s. And it took 90 years or 80 years until 1960 when 90% of America was electrified. This is a form of money that's different than the existing forms of money, but it's being increasingly adopted. And unless that trend changes, now if that trend changes or there's a huge technical flaw, well then I'm wrong and Bitcoin fails. But I think we've got 17 years of data, and I'm comfortable that the odds of a technical flaw are low. And then so I would say then the other only unknown is, will more people keep using this over time? And the evidence so far in 17 years is the answer to that question is yes. And so therefore, I believe it will ultimately emerge as digital gold. Monetary debasement bet similar to gold. I mean, Tudor Jones said he thinks it's the fastest horse in the race. And one thing that I will say makes it better than gold, okay, or different than gold. Everybody knows what gold is. It's been around thousands of years. 8 billion people know what it is. There's no adoption curve in gold. I mean, in fact, there's probably an anti-adoption curve because old people are dying off and they like it. With Bitcoin, there's an adoption curve going on. So it should go up just as the government prints more dollars. The dollar price of Bitcoin could you get higher because there are more dollars chasing a fixed supply of it. That's part one. But part two is, most people don't really know what it is. And I think if you still look at the penetration, it's under 5%. And by the way, gold is similar. I mean, it's stunning to me, given what's going on in the monetary world, that more people don't own some gold. And that's the other 100%. Thing. You don't need to own a ton of this shit. I mean, it's incredibly asymmetric. And so it's kind of like, well, why don't you just own 5 or 10% of it? I mean, I know a lot of people who have nothing but stocks, or if they're my age, they have nothing but stocks and bonds. And I'm like, gee, why don't you think about this thing? It's been performing over 17 years. It's performed very well, and it's an alternative. And if those things don't do well, this thing might do well. And so, it comes down to waiting, right? I mean, you guys are professional investors. I'm a professional investor. We all know that all we're trying to do is handicap the odds, and you can never get it all right. But you're trying to get situations where you think the percentages are on your side and where you think that the upside is bigger than the downside. Like Bitcoin today, for example, it's 70. There's this power law model that shows the value of Bitcoin over the 17 years. And it's actually It's a log of time and a log of price, and it shows a 96% correlation. Well, that's a model that works. Looking backwards, if it's correlated 96% R squared, that's actually predictive. And that model shows that it's traded between zero point 0.5 standard deviations and 2 standard deviations around the mean value. The mean value right now is about 120. Zero point 0.5 standard deviations right now is about 60, which is what it wicked down to. So I actually think if you look at Bitcoin today, I think your downside is it goes to 60. And I think your upside is it goes to 2 standard deviations above 120, which is 2 something. So, to me, that's kind of how I view it. Now, like I say, I'll be totally wrong. If suddenly adoption dies, well, then I'm going to be wrong. But I don't see that.
Lawrence Lepard's analysis offers a compelling roadmap for understanding the future of money. In a world burdened by unsustainable debt and relentless monetary expansion, the search for sound money is becoming increasingly urgent. Gold and Bitcoin, though different in form, are united in function. They offer protection against the erosion of fiat currencies. Gold brings history, stability, and universal recognition. Bitcoin brings innovation, portability, hot and exponential adoption potential. Rather than choosing one over the other, Lepard encourages investors to understand both and to recognize the broader forces driving their rise. As the global financial system continues to evolve, one thing becomes clear. The era of easy money is giving way to an era of monetary reckoning. And in that environment, assets that cannot be printed may prove to be the most valuable of all.